Hello everyone and welcome to a new video. In today's video, we'll be discussing the ADR, which is also known as the average daily range. Now, before we get into the video, I wanted to let you know that I have released a full market structure course. The course includes 12 lessons that takes you from basics to intermediate to advanced levels. It covers market structure extensively and will allow you to understand how we can use market structure to increase our probabilities when trading. Also, it covers multi-time frame analysis step by step, alongside how we can utilize the volume profile tool in order to validate market structure. And yeah, it's priced at £44.99 and the link will be in the description. Now let's get into the video. So essentially, the ADR is the expected range that price will move today in pips between the high and the low of the day. And this is calculated by taking the average pip movement between the highs and the lows of previous days over a specific period of time, right? And this is important because it provides an indication on how far price can travel today according to its average price movement. And this also allows us to make the most accurate possible speculations on how far price can continue to travel in the trend and momentum it's currently trading in. And this also enables us to avoid taking trades where the ADR is exhausted. Now, let's use the ADR5 as an example. And this is not the ADR we'll be using, but let's use it as an example so you guys can understand the concept of the ADR. So essentially what happens is the ADR5 gives us the average range that price is expected to move today between the low and the high of the day, right? And the expected range, which is also known as the ADR, is based upon how far price has moved in terms of pips between the highest and the lowest points of the day over the last 5 days. And what happens is that this gives us the ADR5 figure, which is the range or the pip movement that we expect price to move today between the lowest and the highest point of the day, right? And so essentially the ADR5 provides us with how far on average price is expected to move today, again calculated based upon how far price has moved over the last 5 days. Now, for example, in front of you, we have the last 5 days and we want to find out how far price can travel today. Now, the only way we can find out how far price is expected to travel today is by adding how far price has traveled between the lowest and the highest point of each of the 5 days and then dividing it by 5 in order to get the average. For example, on the first day, price moved 92 pips between the highest and the lowest points of the day. Then the second day, price moved 126 pips. The third day, price moved 171 pips. And then price moved 111 pips. And then price moved 80 pips on the fifth day. And then to find out the average, also known as the ADR, right, what we do is we add all these figures together and then divide it by 5 in order to obtain the average, right? So this is 116 pips. And what this means is that today, price is expected to move 116 pips between the highest and the lowest point of the day. Now, let's have a look at the ADR10, which is the ADR we'll be using. So essentially, the ADR10 is the average distance that price will move today in pips between the high and the low of the day, and is again calculated by taking the average pip movement between the high and the low of the previous 10 days. So it's the same concept as the ADR5, but this time we are taking the average of the last 10 days and not the last 5 days. And this figure allows us to understand how far on average price will move today based upon the ADR10 figure. For instance, if the ADR10 figure is 100 pips, what this means is that over the last 10 days, price on average has moved 100 pips between its high and its low, right? And this means that today the market is also expected to move 100 pips between its high and the low, right? So let's have a look at the ADR10 exhaustion. So the ADR10 exhaustion means that price today between its low and high has moved and met the expected range, which is the ADR10 figure. And this increases the likelihood and probability of a reversal as price has moved its expected range, which basically means that the momentum for today has been maximized and price is highly unlikely to continue in its trend for today. And this allows us to validate points of interest as the bias for the direction of price for today has changed once price meets its ADR10 figure. For instance, if price has been downtrending today and it has met the ADR10 figure, right, it is highly unlikely to continue downtrending and making a new low. So we avoid selling the market because again, it's met that expected range. It is unlikely to trade any lower, right? And once price meets its ADR10 figure, This provides us with an indication of where the high and the low of the day will be. Now let's have a look at an example of the ADR10 exhaustion in downtrending and uptrending markets. So in a downtrending market, we can see that the ADR10 figure is 45 pips. What this means is that on average over the last 10 days, price has moved 45 pips from the highest point of the day to the lowest point of the day. So what we expect is that price will also move 45 pips from the high to the low, right? And currently price has moved 47.5 pips. That is the distance from the highest point of the day to the lowest point of the day. So price has already met its ADR10 figure for the day, because the ADR10 figure for the day was 45 pips, and currently the distance between the highest point of the day and the lowest point of the day is 47.5 pips, which means that the downward momentum is exhausted, right? And the potential to move even lower is unlikely, because obviously that momentum has already been exhausted. That expected range has already been met. So what this means is it's highly unlikely for price to continue to trade lower, and it's also highly likely that this determines the high and the low for the day. And so we want to be avoiding to continuing to sell the market, right? Because we obviously expect price has to reverse, as it's already met that expected range, right? The ADR10 was 45 pips and price has already moved 47.5 pips, meeting that expected range. So we wouldn't expect price to trade any lower. Now, in an uptrending market, it's the same scenario, right? The ADR10 figure is 60 pips. That means over the last 10 days, price on average has moved between its low and high has moved 60 pips. So we obviously expect that price today also moves 60 pips between the low and the high, right? And we can currently see that price, or the distance between the lowest point of the day and the highest point of the day, is 62.8 pips. So obviously price has met its ADR10 figure for the day, which exhausts its buying momentum and potential to move even higher. So it's highly unlikely that price will continue to trade higher, and it's also highly likely that this determines the high and the low for the day. So we want to avoid continuing to buy the market, because the likelihood of reversals increases, because again, price has met its ADR10 figure, which is 60 pips, and currently price is trading at 62.8 pips. Now, if price moves past and is trading greater than its ADR10 figure, this highlights there is greater than usual momentum and volatility for today, for example, news releases. And what I mean is, for example, if the ADR10 figure is 80 pips and price is currently trading past its expected range, for instance, the distance between today's low and today's high is 100 pips, this indicates greater than usual momentum and volatility, which could be driven by news releases and other events. Now, on the other hand, if price does not move its expected range and less than the ADR10 range, this highlights that the momentum and volatility for today in the market is lower than usual. And this could indicate large institutional players are building up their positions in the market, creating a great amount of liquidity. And this means the upcoming days could see large movement in prices, right? And in most instances, prices move 70% of its ADR range. Now, how can we use the ADR in market structure? So the ADR10 figure allows us to speculate where the daily high will be made and where the daily low will also be made, right? That's because once price meets the ADR expected range in an uptrending market, it becomes highly unlikely for price to continue uptrending, because obviously it's met its expected range, right? So it becomes highly probable for price to start reversing. And again, in a downtrending market, once price meets the ADR10 expected range, it becomes highly unlikely for price to continue downtrending, because again, price has met its expected range. So it's highly unlikely price will trade at lower prices, right? And this means in an uptrending market, if price reaches the ADR10 expected movement, it becomes highly probable where today's higher high will be made and price will start reversing, right? And on the other hand, this also means that in a downtrending market, if price reaches the ADR10 expected movement, it becomes highly probable where today's lower low will be made and price will start reversing, because again, price meets this expected range. So it becomes highly unlikely for price to continue to trade any lower and creating a new lower low. So as discussed, in a downtrending market, We obviously know that a new lower low has to be made. It becomes highly probable for a new lower low to be made at the day's ADR low, because once price reaches the ADR low, it means it's met its expected range, right? So it's highly unlikely for price to continue to trade any lower, right, and creating a new lower low. So at the ADR low, price is most likely to create a new lower low and price to start reversing to create a new lower high. Now, in an uptrending market, it's the opposite concept, right? We obviously know that price has to go up in order to create a higher high. It's most probable that price will create a higher high at the ADR high, because at the ADR high, that means price has met its expected range and price is unlikely to continue trading any higher. And this increases the likelihood of price reversing, right, and creating that new higher low. Now, to summarize, the ADR10 figure calculates how much on average price is expected to move today by taking the sum of the pip movement between the high and the low of the day of the last 10 days, right? And then we divide it by 10 in order to give us the average daily range 10 figure. And this figure displays the expected movement in price for today between the highest point of the day and the lowest point of the day, right? And if price is uptrending and meets 70% of its ADR at least, right? Because we said that in most instances, price meets 70% of its range, right? This indicates that price is unlikely to continue uptrending and creating a new higher high, which increases the likelihoods of reversals. So we want to be avoiding to continuing to buy off demand zones, right? And on the other hand, if price is downtrending and meets 70% of its ADR range at least, this indicates that price is unlikely to continue downtrending and creating a new lower low, because obviously that selling momentum has been exhausted, right? So it becomes highly unlikely for price to start trading any lower. And this increases the likelihoods of reversal, right? So we want to avoid selling off supply zones, right? We want to avoid continuing to sell the market on the day once price reaches its ADR low. And the ADR10 expected range serves as a solid level to set take profits, right? Because we obviously know this is where price is expected to go, right? This is where price is also expected to reverse. So it becomes a solid point to set our take profits, which allows us to capture the maximum amount of profit and reward possible. And now I'll show you guys an indicator that will display the ADR10 high and low automatically. Right, guys, let's have a look at the ADR indicator. So I'm on GU, and the first thing you want to do is go on indicators and search TR, ADR, AWR, right? And this is the indicator we're interested in. It's made by Smart Money Concepts, right? So basically, this indicator displays the ADR, which we discussed is our average daily range. This is the range that we expect price to move today. It also displays the AWR, which is the average weekly range. This is the same concept as the ADR, but this time it displays how far this week price is expected to move. And it also displays the AMR, which is our average monthly range. And this is the same concept as the ADR, but this time is how far we expect price to move this month, right? So what you want to do is go on settings, right? And then change this to 10 because we're interested in the ADR 10. Then you can go ahead and delete this, right? And then again, make sure you change this to 10. And then let's make this a nice bright blue color, right? So for now, we're not interested in the AWR and the AMR, and then go ahead and select OK. So basically, this displays the ADR high and the ADR low. So today, we expect price to move 101.57 pips either to the upside towards the ADR high or either to the downside towards the ADR low. Now, as you guys can see, the ADR high is at this price level because between the current low of the day, which is over here, we expect price to move 101.57 pips. So this distance over here is 101.57 pips. And the ADR low is at this price level because we obviously expect price to move 101.57 pips to the downside, right? So there's a possibility if price moves up, it will move to the ADR high. And if price moves down, it will move 101.57 pips from the highest point of the day to this ADR low price level, right? However, what you guys can see is sometimes the ADR high and the ADR low price levels will change because the market creates a new low or a new high for today, right? For instance, this distance over here, right? this ADR high is at this price level because the current low of the day is over here, right? So this distance over here is 101.57 pips. However, if the market makes a new low, for instance, over here, right, we can see that the 101.57 pips distance causes the ADR high price level to fall, right? And this is the same scenario with the ADR low, right? So the current ADR low is over here, and this distance is calculated from the current high of the day, which is over here, right? And then this distance is 101.57 pips. However, if the market makes a new high, right, which is, for example, over here, we can clearly see that the 101.57 pips distance causes the ADR low price level to rise, right? So whenever you see the ADR low or the ADR high price levels changing, that's because the market creates a new daily high or a new daily low, right? So let's have a look at what happens, right? So the ADR high is over here and the ADR low is over here. So we either expect price to move upwards to the ADR high through a 101.57 pip movement, or move down towards the ADR low through a 101.57 pip down movement, right? So let's see what happens, right? So we can clearly see the market is sort of consolidating. So in this scenario, the market did not meet its ADR high or did not meet its ADR low, and this means that there is less volatility and movement than usual. So what this suggests is that the upcoming days will see greater volatility and movements occurring. Now let's see what happens the next day. Today's ADR is 101.53 pips, and again, this is the expected movement, right? So it either goes up 101.53 pips from the low to the high, or either goes down 101.53 pips from the high towards the ADR low. So let's see what happens for today, right? So we can clearly see the market tapped into our ADR low, right? And then the market starts reversing, right? Now, let's see what happens. This is the new day. The new ADR is 103.7 pips, right? So we either expect price to move up 103.7 pips or move down towards our ADR low through a 103.7 pip down movement. Now let's see what happens for today, right? So we can clearly see, right? So let me play that back. We can clearly see the market tapped into our ADR low, and then the market starts pulling back, which is why the ADR low and the ADR high serves as important take profit zones, right? So whenever we're selling off a supply zone, we want to set our take profits at our ADR low, or whenever we're buying off demand zones, we want to set our take profits at ADR highs, because these price levels is where the market is most likely to reverse, right? Because price obviously meets its expected range at this price level. So as we enter a new day, the ADR also changes. Today's ADR is 99.2 pips, and again, price can either move up towards the ADR high in a 99.29 pip up movement, or move down towards the ADR low down here through a 99.29 pip down movement. And let's see what happens, right? So let's see what happens. So as you can see, the market did not meet the ADR high or the ADR low, right? And what this means is that we have lower momentum and volatility for today, which can also display that the institutions are injecting liquidity into the market, which can cause the market to consolidate. Now let's see what happens. Today's new ADR is 91.8 pips, and this can mean that either price can move upwards 91.8 pips from the lowest point of the day to the ADR high, or move downwards 91.8 pips from the highest point of the day to the lowest point of the day. So let's see what happens. So as you can see, right, the market did not meet its ADR range, and again, this can suggest that there's consolidations and the institutions are injecting liquidity into the market. Now today's ADR is 87.43 pips. Now let's see what happens, right? So price meets its ADR high, right? So we obviously expect price to start reversing, right? So let's see what happens. You can see price started to pull back because obviously it's met its expected range. And as I said, whenever we're selling the market, we can set our take profits at our ADR low, because it becomes highly probable that the market starts reversing at our ADR low. And whenever we are buying, we set our take profits at our ADR high, because it becomes highly probable that price will start reversing at our ADR high, because the market meets its expected range. Right, guys, let's have a look at this example. So we can clearly see the market is creating a series series of lower lows and lower highs, a lower low, and now the market is at a supply zone and is now creating a lower high. So we obviously know the market has to go down in order to create a new lower low. But we can also see one of the ADRs has been met, and that is the ADR high. That means that price has met its expected range towards the upside, right? And whenever one of the ADRs are met, it becomes highly unlikely that price will reverse towards the ADR low, right? For example, the ADR high has been met, so it becomes highly unlikely that price will go all the way down towards the ADR low. And whenever the ADR low is met, it becomes highly unlikely that price will reverse upwards towards the ADR high. So in this scenario, what we can do is we can sell the market, right? We can sell off the supply zone, put a stop loss above the supply zone, and then we can aim for 70% of the average weekly range. And remember, the average weekly range is the expected range that we expect price to move for this current week, right? So to get your average weekly range, you simply select your average weekly range over here. So show your average weekly range over the period of 4 weeks, right? So we can clearly see the average weekly range is all the way down at this price level over here. And because we're interested in 70% of the average weekly range, we can select our GAN box, right? And then we can select it from the high to the price level of the average weekly range low. Now, this is the price level where the 70% of our average weekly range is met. And to show you guys, I have 0.7 over here selected in order to show me 70% of this range, right? So again, let me summarize. I expect price to go all the way down and meet 70% of the average weekly range low. Now, let's see what happens. I can set my take profit at the 70% range, right, over here. Let's see what happens, right? So we can see the market rejected nicely, right? So let's continue to extend this, right? So it's obviously it's moving, right? Okay, let's see what happens. Okay, now you can see that price has successfully hit 70% of the average weekly range low. And this is how we can use the average weekly range in order to swing trade and use the ADRs in order to day trade, right? And I hope you guys understand the concept of the ADR and how we can use the average daily range in order to set take profits. And yeah, be sure to check out my website in the link in the description, and I'll see you guys in the next video.